Infamous investor Bill Ackman just said that the markets are imploding because the Fed isn't doing its job. We've had plenty of criticisms here on the channel. Is the Fed doing its job? Are their hands tied? What else could they do? Should they do a full point rate hike at this point? Some of the CNBC genius pundits also weighed in on this, saying that the market is imploding because of the Fed, but not because they're not doing their job, but because they're doing too much. There's also growing consensus that the Fed might take their foot off the gas pedal by the end of the year. And then lastly, Snap shares plunged 40% today after admitting that their previous guidance, the one that they just gave a month ago at their last earnings release, was too optimistic and that they were going to come in at the low end of that guidance. This could be a canary in the coal mine situation if other mid and large cap companies come through with their own earnings revisions saying that their guidance was too optimistic and now they are not going to be meeting those guidance numbers. We will get into all of that. If this is the first time on the channel, welcome to the Traveling Trader. Happy to have you. My aim is to always provide you with the most concise, accurate, no BS market updates, and let us get right into it. So the bear with the bullhorn, Bill Ackman, once again sounds off on Twitter saying that the Fed must do whatever it takes and follow up with even more aggressive rate hikes. However, he actually did state something that I wholeheartedly agree with. He said stocks of real businesses are cheap once again. This is actually something that I said this morning on the Discord and in previous videos, saying that markets will soar once investors can be confident that the days of runaway inflation are over. Right now, that is the major roadblock here. The market is not convinced that inflation is under control. As a matter of fact, price instability is so out of control that we saw our first quarter of negative GDP. And as you guys know or may not know, another quarter of negative GDP puts us officially into a recession. The way that prices are trending, I don't think anyone would be surprised if we get another quarter of negative GDP. Right now, most analyst bets are against that. However, it will not be surprising to anybody if that happens. We are starting to see major slowdowns in the economy. The home sales numbers came out today, and we are 16% down in April while prices soared. This is not a good sign when it comes to the topic of stagflation. Stagflation happens when prices continue to rise, wages continue to rise, but the economy is slowing down in the other direction. When those two counter trends keep moving, the price is going up and the economy going down, that is what could lead to a stagflationary environment. Continuing on Bill Ackman's comments, Bill Ackman's main gripe with the Fed is that even though they raised by 50 basis points, which is something that normally doesn't happen or hasn't happened in at least in recent memory, they are once again telegraphing a more dovish position. That means a softer position, and they are set to still remain behind the curve. We've had various Fed members come out in the last few days saying that they might take their foot off the gas towards the end of the year, obviously depending on what happens with inflation. Bill Ackman is arguing that the Fed shouldn't even entertain this softening of monetary policy, and they should aggressively continue to attack on the federal interest rate fund as well as on the balance sheet front in order to combat the type of inflation that we have. He said if the Fed doesn't do its job, then the market will do the Fed's job. And this is somewhat true, although the stock market and the economy are two separate things. The Fed isn't really supposed to care about the stock market. They're only supposed to care about the economy, and then the market will do its thing because it is supposed to be a free market based on what is going on in the macroeconomic landscape, right? So if the macroeconomic landscape is under control, then businesses will be better positioned to then come out with better guidance, to beat earnings, to grow. However, if the macroeconomic picture is messy as it is now, that means that the business landscape is also not settled. Now, some of the pundits on CNBC have a somewhat different take, saying that the markets are crashing, but it's because of the Fed's policy, right? So which one is it? Is it the Fed's inactivity that is causing the market to crash? Or is it the Fed's activity that is causing the markets to crash? In a weird way, it's a little bit of both because the Fed has been behind the curve, if you ask me. There was a chance to raise rates to neutral before COVID. However, when COVID hit, then there was no choice and we had to go to a zero Fed funds rate. And the Fed had to come in and prop up the economy because all businesses were shut down. However, coming out of the pandemic when the economy was roaring and we had record GDP, the Fed should have acted swifter then, but they did not want to tip the balance. And now we are behind the curve. Let's take a listen to CNBC and I'll give you my analysis and my investment profile at the moment. Let's go.
Not on the economy, but we're in a downturn. And sadly, it's a downturn that's being being caused by Fed monetary tightening in response to the things that are going on environmentally related to inflation, the war, and shutdowns in China.
So he said that it's caused by Fed monetary tightening. And Bill Ackman is saying that the Fed hasn't done enough, and that's why the markets are imploding. Again, this is a weird scenario where it is a mix of both, where both things can be true, that the Fed hasn't done enough before this, right? And where now what the Fed is trying to do is to tighten in an economic downturn, usually tighten when the economy is roaring.
And the critical thing for the market now is when the Fed pivots. And so we're in an environment where things getting worse are actually going to have a great setup for when the Fed's able to do that. I think we're all surprised.
Bill Ackman said the same thing, and I agree as well, that there are stocks that are too cheap, and we'll get into this when I talk about my investing and trading after this segment, that there are stocks that are too cheap to ignore right now. And when inflation does get under control, there's actually an opportunity to make life-changing money on investing in quality companies that right now are historically very cheap.
At the pace of deceleration that we're seeing. And so we know the Fed's going to tighten at the next two meetings. We know we're going to get 50 basis points in June, 50 basis points in July. And then I think it sets up from a timing standpoint for an August, September, which could be reasonably good if the Fed does pivot. I will tell you.
Why do you think they're going to pivot? Why do you think they're going to pivot? What gives you any reason to believe that they're going to pivot?
By pivot, they mean slow down or pivot on their monetary policy. So going from aggressive to dovish.
I'm just curious because I keep hearing that from people, and I'm wondering what backs that up.
What I would tell you is the pace of change that we're seeing in deceleration. Look at Snap. They reported earnings on April 21st. That is only a month ago. Look how quickly things decelerated for them. Look how quickly they had to warn. In addition, we're seeing a lot of things.
Maybe they did a bad job with their guidance too. I mean, people are just are also taking this. Oh, the environment deteriorated so much over the last three weeks. Maybe they didn't do a good job when it came to giving their guidance. I don't know.
All right. So this guy's saying that the Fed, and not only him, by the way, like I said in the outset of the video, it's sort of a growing opinion that the Fed will have to pivot or slow down by the end of the year. Now, the reason that they think that is because we actually have a history of this. This is not unprecedented. So many times in history, and this is one of my favorite articles about the Fed and its history of rate raises, quantitative easing, quantitative tightening, etc. Time and time again, the Fed has committed, aside from Paul Volcker in the late 70s and early 80s, time and time again, when the Fed has committed to quantitative tightening or monetary tightening to rein in things such as inflation, high unemployment, etc., they have a history of pivoting. As you see here, the last time, this was even before the pandemic in December 2018, when we had a market crash, the Fed promised to stop raising rates, even though based on the schedule that they had outlined and telegraphed beforehand, they were supposed to continue raising rates. And even though the economy was strong, we had decent GDP, unemployment was low, inflation was low, the Fed stopped raising rates because the market was dropping. And this is where, a lot of economic purists get really pissed at the Fed because they think that the Fed is actually watching the stock market when they shouldn't be watching the market at all. They should just be concerning themselves with the economy. So how am I looking to invest this? Well, first of all, put your email address in the form below if you want access to our free watch list every single week. I send out the stock watch list going over notable events for the week, as well as what I'm looking to potentially dollar cost average or invest in. This is very poignant, especially for this time, since we do have an economic downturn and and a stock market downturn, and being very selective about what you invest in is probably more important now than ever. And also on the Discord, we do have our day trade watch list every single day where we play options depending on which way the market breaks. We send this out every single morning. We have the put side ready, we have the call side ready, and if the stocks that we're looking at breach either level, then we either buy the calls if they breach resistance or the puts if they breach support. This allows us to wake up, stay neutral, and play the positions based on what the market is giving us. Today, we had 33% on the SPY, 37% on the Qs, 40% on IWM. I didn't even play Apple and Nvidia because I was done an hour after the market opened. So if you want access to this, our long-term, short-term crypto options, futures, etc., link is in the description below. Come be a part of a community. Don't go at this alone. So how are we investing in this? Well, besides the options and day trades, if we're talking about from an investment standpoint, just like Bill Ackman said, that stocks of real businesses are cheap once again. He's not lying. If you look at this from an objective point of view, the S&P forward PE ratio is 17.6. That is below the 5-year average of 18.6. And yes, the S&P 500 can have a PE ratio. This is just basically the price earnings ratio for all companies in the S&P 500. So if you take the conglomerate or the aggregate, of all the companies in the S&P 500 and you come up with the PE ratio, you will get a good measure of whether the stock market is undervalued or overvalued. And right now, we are below the 5-year average. So even though the stock market could look like it's rising into oblivion, if we look at the stock market indexes relative to the prices of the underlying stocks, then the stock market is actually relatively cheap. It's cheaper than it has been on a 5-year average right now. Now, the only reason that I'm not investing all in here is because, as I said time and time again, during times of show and prove, when we're not in stock market hysteria, all the market cares about are earnings. If there's a possibility that earnings are going to deteriorate because of price instability, high PPI, etc., the market does have more room to drop. Earnings are everything in this market environment. And you saw how quickly a company like Snap dropped today, 40% just for saying that it's not going to meet its higher end of the guidance. It will probably come closer to its lower end of the guidance, and it dropped 40% without warning. So I do think that one can actually be rather patient here, waiting for how the price instability issues look to be between now and the next round of earnings in the summer. However, I do think you could start to nibble on the S&P 500, on the NASDAQ. The NASDAQ is down almost 30%. S&P 500 is not even in bear market territory yet because it's not technically 20% down. It's 18 and change. You could look at stocks that people have been wanting to own at these prices forever. Apple, Amazon. You can look at Chipotle, for instance. You can look at Walmart right now, right? Walmart is historically cheap after this earnings overreaction here. I'm looking at Berkshire Hathaway here at historically low prices, near the 300-day moving average, something that it doesn't typically hit. Also, take a look at high dividend ETFs like VYM or DVY, because if you're able to at least collect a dividend that's worth half of what the year-to-year inflation is, and you are also investing in a company, meaning that, that dividend is not taking care of the 8% inflation. However, you're also investing in a company at historically low prices. So you're hopefully getting some of the equity of that company as well. XLV, which is the healthcare sector of the S&P 500 at the 300-day moving average, healthcare is one of the sectors that tends to be recession agnostic. It doesn't mean that it sees the moon during a recession, but it tends to depreciate at a much lower rate than other stocks in the market because healthcare, unfortunately, there is no respite when it comes to health. And during recessions, actually people's health deteriorate even more. Anyway, traders, that is it for this video. Sign up if you want more of my analysis and my assessment on stocks, options, etc. Link is in the description. Right now, you get 30% off the memberships. Leave a comment down below. Let me know what you think of Bill Ackman's comments. Do you agree with him? Is the Fed doing too much? Is the Fed not doing enough? Let me know what you're investing in. I love hearing from you guys. Hit that thumbs up, subscribe to the channel. Stay safe out there, traders. Peace.